Vanguard just published a report that says the next 10 years of stock market returns will look nothing like the last 10. The S&P 500, 3 to 5% annually. US growth stocks, think the mega cap tech names everyone owns, potentially as low as 2% per year. And unemployment creeping toward 5% with inflation stuck around 3. That's the base case, not the pessimistic scenario, the base case. So here's a question. If you spent the last decade assuming 12% annual returns because that's what you got, and you built your entire retirement plan around that number, what exactly happens to your math when the machine that made you feel smart suddenly slows down by 60%? That's what I want to talk about today. I'm going to explain how the retirement math worked for the last decade, why Vanguard is saying it's structurally broken now, and why it's getting really weird in ways most people aren't talking about. This isn't doom and gloom. It's just incentives and arithmetic, which turn out to be more frightening than any conspiracy. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They use assumptions that haven't been realistic in 15 years. It uses BlackRock and Vanguard's own logic to find the weak spots in your plan. Link in the description. I only ask for your email to send the report. All right, let me give you a model. One metaphor I want you to hold on to for this entire video because I'm going to keep coming back to it. Think of your retirement portfolio like a river feeding a town. For 10 years, there was a lot of rain upstream. The river was fat and fast. The town grew. People built houses right on the riverbank. They planted crops that needed constant water. They made long-term plans based on the assumption that the river would always be this wide. And it worked. Nobody got flooded out. The crops grew. Life was good. Now, Vanguard is the hydrologist who just came back from upstream with some charts. And they're saying, look, the rain pattern is changing. The river isn't going to dry up, but it's going to be narrower. And the people who built their houses closest to the water, who are the most dependent on high flow, they're the ones with a real problem. That river is market returns. And the people with their houses on the bank, that's anyone who's in or near retirement right now, especially boomers and Gen X who've been riding the best decade in modern market history and quietly assuming it would just continue. Here's how good the last decade actually was. From roughly 2013 to 2023, the S&P 500 returned an annualized rate of approximately 12.4%. If you had $400,000 invested in 2013 and just left it alone, you'd have about $1.3 million by 2023. That's not skill. That's weather. You lived through a long rainy season and the river was full. Now, Vanguard's forecast for the next 10 years, US large cap equities 3.1 to 5.1% annually. Let's be generous and use 5%. Same $400,000 over the next 10 years at 5%, you end up with around $650,000. Not 1.3 million, 650,000. That is a $650,000 gap on the same starting amount just from the return assumption changing. But you might be thinking, okay, 5% is still positive, the market's still going up, I'll be fine. And here is exactly where the river metaphor matters. Because the problem isn't that the river disappears, the problem is that the people who made plans assuming the river stays wide are now underwater financially speaking because their whole system was calibrated for more flow than is coming. Now this is where it gets really interesting because Vanguard doesn't just tell you returns are going to be lower, they tell you where they actually see opportunity. And the answer is not where most Americans are parked. They see US value stocks returning 5.8 to nearly 8%. Developed international markets, 5.7 to 7.7%. Global equities broadly, 5.1 to 7.1. The areas with the highest projected returns are the areas most American retirement portfolios are dramatically underweight because the last decade made international and value look like losers. Here's a story that illustrates this perfectly. There's a farmer in the Midwest, classic parable type, good farmer. For 10 years, the East Field consistently outperforms better soil, better drainage, better yields. So every year he shifts a bit more of his planting to the East Field and a bit less to the West. Logical, right? Until there's a soil depletion event in the East and suddenly the West Field, which he almost abandoned entirely, is producing twice the yield per acre. And he barely has anything planted there. The farmer isn't dumb. He was following incentives. The East Field rewarded him repeatedly, and he responded rationally to that signal. The problem is that 10 years of signal created a structural imbalance right before the signal changed. That's the S&P 500 concentration story in one paragraph. The top 10 companies in the index now represent close to 40% of its total value. You think you're diversified? You're actually running a very concentrated tech bet with a side of everything else. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Now, let's talk about the economy piece, because the stock market and the economy are not the same thing, but they're related enough that this matters. Vanguard's forecast for the US economy right now, GDP growth of about 1.5%, unemployment rising to around 4.7%, and core inflation sitting stubbornly at 3%. For those of you keeping score at home, that's low growth, rising joblessness, and prices still climbing. The technical term for that combination is stagflation adjacent. The less technical term is annoying for everyone, but especially punishing for retirees. Here's why inflation is specifically brutal for people in or near retirement and has nothing to do with groceries being expensive, though yes, that too. Imagine you're a retiree. You've got a nest egg. You've calculated that you can safely withdraw, say, 4% per year. On $1 million portfolio, that's $40,000 annually. The 4% rule, which by the way was developed in the 90s and was never designed as a universal law, it was literally one financial planner's historical backtest. The 4% rule assumes you don't erode the principal too fast. Now add 3% inflation. Your $40,000 in spending power this year becomes $38,800 in real terms next year, and the year after, and the one after that. Meanwhile, your portfolio is growing at 5% nominal, but maybe 2% real after inflation. The river is narrower and the town is bigger. You see the problem. There's a guy fictional, but you know this guy. Let's call him Dave. Dave retired at 63 in 2021. He had $900,000. He ran the numbers on a basic online calculator, punched in 7% expected annual return, set his withdrawal rate, and the calculator said he'd be fine until age 92. Dave was thrilled. Dave printed the chart and put it on his refrigerator. Dave's calculator used 7%, because that's roughly the historical long-run average for the S&P 500. It did not account for sequence of returns risk. It did not account for the Vanguard forecast. It did not account for 3% sustained inflation eating his purchasing power. And the calculator was free, so naturally it was accurate and thorough in every way. Dave, your retirement calculator is from 2008. Yeah, but it said I was fine. Dave, this is actually a serious point dressed in a joke. Most publicly available retirement calculators are mathematically optimistic in ways that serve the company hosting them, not you. Higher return assumptions mean you feel safer, you invest more, they earn more in fees. The incentive structure of a free financial tool does not point toward brutal honesty. Now, here's the reversal I want to give you, because I think most people are focused on the wrong variable entirely. You think the problem is low returns, but actually, the problem is sequence of returns. Let me explain. Two investors both average 5% per year over 20 years. Same average. Investor A gets the bad years first, loses 15% in year 1, 12% in year 2, then recovers with gains in years 3 through 20. Investor B gets the bad years last. Same average return, same 20 years. Investor B ends up with significantly more money. Why? Because Investor A was withdrawing money during the down years. He was selling shares at low prices to fund his life. Those shares he sold at a loss in year 1, they never recovered for him because he didn't own them anymore when the recovery happened. This is called sequence of returns risk, and it is the single most underappreciated concept in retirement planning. Not returns, sequence of returns. When Vanguard says the next decade looks like 3 to 5% with volatility, they're implicitly saying the sequence risk is elevated. The range of possible outcomes is wider. And for someone who just retired or is about to, that width is not your friend. This is where it gets really interesting, because Vanguard actually has a third piece in their research that most people gloss over: the shifting nature of retirement itself. Their survey of 1,500 people found that 62% of non-retirees expected to retire gradually, reducing hours, shifting to different work, stepping down slowly rather than stopping cold. Only 38% of people actually manage to do it that way. The gap between expectation and reality on this specific point is 24 percentage points. Translation: people plan for a soft landing and get a hard stop. Health events, layoffs, company restructurings, burnout reality tends to make the retirement decision for you, not the other way around. Financial advisor voice: the plan is to work part-time consulting until you're 67. Reality: your company was acquired and they don't need your role anymore. You're 61. Congratulations, you're retired. This matters because if you're planning to fund a gap in savings with a few more years of part-time work, that plan has a historical failure rate that nobody puts in the brochure. All right, let me make this concrete with a mini case study. Real numbers, fictional person, Linda, 58 years old. She has $480,000 in her 401k, mostly in S&P 500 index funds. Her financial plan built on a 7% growth assumption says she can retire comfortably at 63 with about $3,200 per month in withdrawals, supplemented by Social Security at 67. Now run the same plan at Vanguard's 5% nominal return assumption and 3% inflation, so roughly 2% real return. Her portfolio at 63 is about $100,000 smaller than projected. Her real withdrawal power is eroded. And if she hits a bad sequence in her first 5 years of retirement, which statistically can cut a portfolio's longevity by a decade, she is looking at a fundamentally different retirement than the one she planned. What does Linda actually need to change? 3 specific things. 1, she needs to rebalance away from pure US large cap concentration. Vanguard explicitly flags developed international and value as having better return prospects. This is not exotic. This is Vanguard's own words. You don't have to go buy emerging market small caps in a country you can't find on a map. Just tilt toward areas that aren't priced for perfection. 2, she needs to think about her withdrawal sequence, not just her withdrawal rate. A cash buffer of 1 to 2 years of expenses, kept outside equities, means she is not forced to sell stocks at the worst possible time. The buffer absorbs the sequence risk. This is not complicated. It's just not exciting enough for most financial content to cover. 3, she needs to stress test her plan against 3% inflation, not 2. 1% difference in inflation assumption over 20 years of retirement is not a rounding error. It is the difference between comfortable and concerning. Now here's the broader point I want to leave you with, because it connects back to the river. The last decade trained an entire generation of investors to believe that the default state of the river is wide and fast. It isn't. The wide, fast river of 2013 to 2023 was the anomaly. Near zero interest rates, massive quantitative easing, unprecedented tech sector growth, pandemic stimulus. These were rain events. The river ran full because of specific upstream conditions. Those conditions have changed. Vanguard isn't telling you the market is going to crash. They're telling you the default expectation you absorbed from a decade of incredible returns needs to be recalibrated. That's not bearish. That's just accurate. Lazy investing built more fortune than crypto memes. But lazy investing built on wrong assumptions is just slow financial erosion with good vibes. 3 practical takeaways, not generic, actually specific. First, if your retirement calculator assumes more than 5% nominal returns over the next decade, run it again at 4% and see if your plan survives. If it doesn't, you want to know now, not in 3 years. Second, check your international allocation. If you have less than 20% in non-US equities, you are making a bet that the US continues to dramatically outperform the rest of the world. That's a legitimate bet. But own it as a bet, not as a default. Third, build a 2-year cash or short-term bond buffer before you retire. Not because markets will crash, but because you do not want to be forced to sell equities at a loss in year 1 or 2 of retirement to fund your groceries. Sequence risk is the hidden tax on underprepared retirees. The river's still flowing, it's just narrower now. And the people who plan for flood season are the ones who need to move their houses.